Here is our roadmap, finance roadmap. Simply put, finance is the study of money and how it is used. Of course, it's much complicated. So I want to share some sub-areas of finance with you. Finance consists of four main bodies: corporate finance, investment, financial markets and institutions, lastly, international finance or international trade. With advanced technology, there are new areas of finance such as alternative investment and financial technology, as known as fintech. Please remember this. Each area interrelates with all the others. Today, we will discuss the capital asset pricing model, CAPM, under investment category. Before we jump into that, there is one important thing I want to address. During this pandemic, there has been some uncertainty. COVID-19 is everywhere. Many countries, people have a lot of trouble with it. But our financial market tells a little bit different story. During this period, stock market flooded with a lot of new investors. More people are turning to the stock market for entertainment and profits. Their activities increased dramatically. Guess what? Stock market performed well as a result. Look at this chart. These stocks finished 2020 gaining more than 100%. All three major indices, such as Dow Jones, S&P 500, and Nasdaq in United States, were great as well, right? Tesla, FC, PayPal, Nvidia, and I'm pretty sure you have heard a crazy story of GameStop conflicting interest between hedge fund and individual investors. Bitcoin, I don't have, said enough, so no comment. From the outstanding 2020 US stock market performance, we should consider risk and return trade-off. High risk, high return. Alright, we have two following questions. How to measure risk, how to measure expected return. Let's start with expected return. Here, we will employ the capital asset pricing model to measure expected return. How to measure risk. Here, we have two different bases: standalone basis and portfolio basis. We follow the portfolio basis and focus on systematic risk, not unsystematic risk. Why? Because unsystematic risk can be eliminated for free through diversification. So here we only focus on systematic risk. Overall, we have two important elements for capital asset pricing model: systematic risk and expected return. Let's recap the story. COVID-19 hits our economy in 2020. Stock market flooded with a lot of new investors and performed well. Here, we consider risk and return trade-off. Employing capital asset pricing model, we can see the relationship between systematic risk and expected return. Sounds good? To explain capital asset pricing model, I will start with a simple linear model. Do you remember the equation of a straight line? Of course. Y equals mx plus b, and m means slope and b means intercept, right? How to calculate m and b? Well, slope equals what? Change in y over change in x. Delta y over delta x. What about an intercept? When x equals 0, you can find the intercept. So, in our case, we can calculate our simple linear equation. Y equals 1x plus 2. Next, capital asset pricing model. It will be simple if you understand simple linear model. Here, we just need to change some words on the linear equation. So instead of y equals mx plus b, we will use some fancy words for capital asset pricing model. Here we go. Instead of y, m, x, and b, we will use expected return, systematic risk or beta, market risk premium, and risk-free rate. If you confused, please see the box below. It will help you to understand the capital asset pricing model mathematically. Usually, when we discuss the capital asset pricing model, beta given. So I will not go over how to calculate beta, but once you know how to calculate covariance, correlation, variance, and standard deviation, it will be easy to calculate. Sounds good? Before we try to practice questions, let's repeat the capital asset pricing model equation. Expected return equals to systematic risk or beta multiplied by market risk premium plus risk-free rate. Here, market risk premium is what? Expected market return minus risk-free rate, right? I'm pretty sure you are ready for practice questions. Let's move on. Let's try practice question 1. Here the question. The expected return on the market is 18.4%. The risk-free rate is 1.611%. And the beta for stock A is 1.2. Calculate the rate of return that would be expected on this stock. So, our job is clear. Given information, we need to calculate the expected return of stock A, right? Let's recall the capital asset pricing model equation and summarize the question. We good so far? Given information, expected market return equals to 18.4%, beta for stock A equals to 1.2, and risk-free rate equals to 1.611%. Guess what? Plug and chop, and you will find the expected return of stock A. In this case, 21.758%. We good so far? Good. Alright, next, real world case. Tesla. Here we go. I collect this information from Yahoo and CNBC Finance. This case, you need to calculate expected return of Tesla, right? Let's summarize given information. To measure expected rate of return, we need to market return. In this case, Nasdaq market return, 18.4%. Beta for Tesla, 2.06, and risk-free rate, 1.611%. Guess what? Plug and chug again, and you will find the expected return of Tesla, 36.196%. We good so far? Good. Alright, now let's visualize our two practice questions. Here's the summary of our two practice questions, and you can see the straight line below. And it is the security market line. What is the security market line? It is a graphical expression or representation of the capital asset pricing model that plots expected return versus beta for any security. In other words, y-intercept will be expected return and x-intercept will be systematic risk or beta. So far so good. In our case, stock A and Tesla, two securities, right? Alright, let's plot together. Risk-free rate 1.611% here, and what about stock A and Tesla. Here we go. According to our graph, you can see expected return of Tesla is much greater than expected return of stock A, right? Also, you can see that it comes from beta. Both stock A and Tesla have the same market return and risk-free rate, but beta for Tesla is much greater than beta for stock A, resulting higher expected return. Guess what? High risk, high return. Still remember? So here, high systematic risk or beta, high expected return. We go so far? In real world, financial analysts employ different techniques, so they have different opinions and conclusions. For example, one analyst says, buy Tesla, but another analyst say, sell Tesla. If his or her forecasted return is below the security market line, the stock is overvalued and you should sell it. If his or her forecasted return is above the security market line, that stock is undervalued and you should buy. If they are same, please hold it. Sounds good? Alright, let's move on. Now you can calculate the expected rate of return of stock using the capital asset pricing model and plot your result on security market line. Theoretically, capital asset pricing model has 7 assumptions here. Sadly, these assumptions are somewhat unrealistic, indicating that capital asset pricing model has limitations. Let's wrap up our class. Today, we discuss the capital asset pricing model and its application in real world. Also, we visualize our calculations. Capital asset pricing model is very simple and powerful. However, certain assumptions are unrealistic. In academia, many researchers and practitioners have improved the capital asset pricing model, bringing more factors to cover its drawbacks. Sounds good? Alright, thank you so much and have a great day. Bye.